Good evening, everyone. So thank you for taking out your time on this Friday evening on this webinar, which is on the topic 53rd GST Council Unplugged. What's new and what next? Without taking much time, I'll invite Mr. Rishabh Singhvi to share his insights on the topic and also set the context. Over to you, Rishabh.
Am I audible? Yeah.
Yes.
Thanks, Rahul. Good evening, everyone. It's a pleasure to have you all at the ECA webinar on the 53rd Council GST meeting. The objective of this webinar is to really get into familiarize ourselves with the flood of circulars which have emerged in the recent weeks. The reason why these circulars have been issued is because there have been a flurry of activity at the ground level in respect of certain niggling issues which the law does not provide explicit answers. Many of this have also reached higher forums, be it the appellate forums or the tribunals and the High Court as well as the Supreme Court. Of course, the tribunal is not yet set up. I think the GST Council has taken a proactive step in addressing many of these issues, and they have really taken care to address the issues in a slightly liberal manner so that the corporate interests have been taken care of. To cite a few, we have circulars on corporate guarantees, which was a burning issue, and Rahul will going to take you through those matters. We had a flurry of notices pursuant to the secondment arrangements between holding and subsidiary. Implicitly, the council has even taken care of those notices where parent subsidiary transactions have been slightly liberalized, keeping in mind the overall intent of the law. So now 7 years into GST, and somewhere the council is taking cognizance of certain litigation which is emerging because of the holistic approach or the holistic view getting lost at the ground level. And we are all experiencing this when we are undergoing the audits of which commence from 17-18 right up to 21-22, 22-23, either from the state wing or from the central wing. So we should really take these circulars in good stead, understand the principles which are there. Of course, within this next 1 hour, Rahul and myself would be taking you through some of the key circulars. We would not have covered certain sector-specific issues in this on the circulars, and that can be taken up offline if anybody is of keen interest. The objective of this is to have a generic discussion without getting into too many technicalities, because I'm sure the circular is going to leave certain corners or certain loopholes which the department may want to really examine. I think we may not go into those extreme loopholes and corners. We will try to understand the flavor, derive the principles which are emerging from them, and also bring to light what are the next steps or actions we need to take as on today, as corporates facing the GST assessments and audits, what actions we need to take, what decisions we need to make, so that we are in line with the legal requirements and we do not face any of those technical actions, right? I think with this brief introduction, I would not want to go into too much on the preface to this. I would like to directly dive into the topics. How we've planned out the session is I would take a couple of issues, 4 to be specific. Rahul would take the other 4. Then I'll again come back and take some of the other issues, and Rahul will take the rest. We propose to have a Q&A session at the end. Any intriguing questions, any queries, any practical difficulties anybody is facing, we may like to hear them out and see if that can be resolved by these circulars. Mind you, there were some more decisions of the 53rd Council which may require a legislative amendment, an amendment in the primary enactment, that is the GST Act itself. That is due to come naturally because there has to be a synchronous amendment across all states and center. So that's going to take some time. Possibly you may see a flavor of it in this upcoming budget. But the circulars and the notifications have now on the table for us to examine and understand. With this, let's start off with the first issue. Now, friends, this has been a very intuitive issue, I may call. We are all working in a multinational, setup where parent subsidiaries cross boundaries. I would believe that transactions between the parent and subsidiary could be explicit and could be implicit. Now, explicit transactions, none of us have a dispute, no dispute between us and the department, and we pay the taxes accordingly. If it's an export, we claim our export benefits. If it's an import, we pay the taxes under reverse charge and claim credit, so on and so forth. No issue. And that's explicitly available on the face of accounts. The challenge was emerging in respect of the implicit transactions. To give you a very simple example, Microsoft India using the brand name of Microsoft US. Google India using the brand name of Google US. Now, if there was no separate transaction identified in respect of use of a brand name or an IPR, or for that matter, if the subsidiary is under the supervision of an overseas management, the department was contending that there is an implicit service between the holding and the subsidiary. By contending this implicit service, they were saying that you are liable to tax under reverse charge. Now, this was creating a lot of litigation. Firstly, whether this at all was a service or no. Secondly, what was the value of the service? Now, the government has taken cognizance of this. The GST Council has taken cognizance of this. They have addressed the second symptom, if I may have to put it down. They have said that if that at all there is a service, then between the holding and the subsidiary, if the subsidiary is eligible full input tax credit, yeah, I may call it a revenue neutral situation for the government because you pay the taxes and you get the credit. In such situations, the value which is declared in the tax invoice or the self invoice is considered as the value for the purpose of RCM or the reverse charge. If there is no value, then what? In such cases, also the government says we'll deem it to be zero and no RCM is payable on us. What happens if the full ITC is not available? So we've had one scenario where full ITC is available. What happens if a full ITC is not available? In such cases, the government has clarified that you will have to go by the default rule. And the default rule is identify the open market value of such brand name or such management service, whatever we may identify, and then pay that reverse charge on that. And that would certainly become a cost for the subsidiary. What is full ITC now becomes very critical. Does it have to be looked at an invoice level? Does it have to be looked at an entity level? Does it have to be looked at for a particular financial year or a particular month? I think those are certain unanswered questions. And this is going to create the next level of derivation of issues from the department. But the takeaway is that in revenue neutral situations, the RCM liability will be only restricted to the value which is declared in the invoice. And if the invoice has a zero value, then no RCM is payable. I think this is a welcome circular for all the current ongoing litigation. You must be aware that we are facing this flood of issues on secondment on account of the Northern Operating Systems decision. Possibly this circular is an outcome or a fallout of that decision because the industry has lobbied very hard to reduce the rigors of that decision in the GST period. I think we need to take this a step in the right direction and hopefully wait that the full ITC issue which is open is also addressed in the near future. Then we'll go on to the next issue. This is a slightly simpler issue. It's not an issue as such, it's more a relief or a breather to the corporates. We all know that if you are under litigation, you need to deposit a particular amount of tax to go on appeal as a prerequisite for appeal. This is in respect of all the taxes which are confirmed either under section 73, 74 of the CGST Act. For the first appeal which we have before the Commissioner Appeals or the Joint Commissioner Appeals, you need to pay 10% of the tax in dispute. Subsequently, if you propose to go for an appeal before the tribunal, you may have to file 20%, that is 10 plus 20. So effectively, you pay 30% of the tax in dispute. 30% was working out a big chunk of the liability, especially where many of the demands have been high-handed, have been inflated because of a purported tax liability by the tax officer. They have reduced it from 10 plus 20, effectively 30, to 10 plus 10, effectively 20. So the percentage of pre-deposit versus the total tax and dispute is capped at 20% when you file the appeal before up to the tribunal. We all know that the GSTAT is on the cards. We are in the 7th year and it is being rolled out. We have the notification, but the tribunal benches have to be set in place. So until that time, you will have to deposit these taxes. I must tell you that last night, the board has issued a circular. We have all been in appeals for the first level and either we have got dismissed or in our favor. If the appeal has been dismissed, we are awaiting the tribunal to be set up to file the second appeal, and hence we have also withheld or stayed put on the balance 20%, which was the law until this amendment comes into effect. Now, the department was saying that, see, the appellate order is against you. Yes, I recognize that the tribunal is not in place, but the law allows me to do a recovery if you don't have a stay and if you have not filed an appeal. So people all the department officers were pursuing, of course, because of revenue pressure, the balanced 20%, in many cases, even the 100%. I've heard cases where they are recovering the balance 90%. So overall, 100% of the tax demand was proposed to be recovered. Maharashtra had issued a circular saying that if an undertaking is submitted and the balance 20% is deposited, the balance amount will be stayed as a stopgap measure. Now, the central board has also issued directions that if the first appeals order is against you, against a tax demand, you would have already deposited 10%. The balance 10% has to be deposited by you, balance 20% until the law is amended, and the balance 10% once the law amendment comes into effect. And then you have to file a declaration. Mind you, if you don't file this declaration, it will be presumed that you are not proposing to file an appeal to the tribunal and you have accepted the first appellate order. So this is a very critical action point for us, that we have to immediately take stock of all the appeals, inventorize all these appeals across India. We are having jurisdictions across India. You'll have to immediately inventorize this, take up a task, file a declaration or an undertaking to your jurisdictional officer who has passed this order, intimating him about the balance 10%, and then wait for the tribunal. I think this is an added compliance, but very necessary compliance in our interest. Now, key points to note is that this pre-deposit, whether it can be paid through cash or credit, I am of the firm view this can be paid through credit. I don't see any dispute on that. But there have been certain challenging decisions which at the High Court. I think the law it's before the Supreme Court. I think the law has to settle in favor of the taxpayer that credit is as good as tax paid, and you should be allowed to make a pre-deposit of the tax and dispute through an ITC mechanism. There is a functionality which is proposed to be developed for all these processes. I think those are, junctures as and when we face it practically, we may have to address. But conceptually, there has been a reduction in the pre-deposit. The overall cap of pre-deposit, the absolute cap is also fixed. It is reduced from the existing 50 crores, 25 and 50 to 20 crores each for the first appeals. I think we'll go on to the next issue. Warranties. Now, this is critical for the participants or corporates who are in the manufacturing sector. we've already had a circular on warranties. Okay. Primarily, the warranty is issued by the manufacturer to the end customer directly. The distributor is a via media or somewhere an intermediary in this arrangement. Now, because of the proximity of the authorized service center or the distributor or the authorized service station, the customer visits these service stations and gets its product or a part replaced. Now, there are 4 or 5 variants of this. And the dispute came back is whether this warranty is taxable or not, or a separate GST supply. Let's say you have a defect as a consumer, you have a defect, or you're and you approach the the manufacturer directly for replacement of this product or the part. The manufacturer directly sends those goods to you, and you get the part replaced in terms of the warranty conditions. It is generally through a delivery challan. It's not a tax invoice. The circular has clarified that there is no GST liability on such transaction. The manufacturer also, who is providing this warranty, is also not required to reverse the ITC. That's point one. But in automobile sector, in the consumable goods sector, or in the electronics industry, the customer approaches the distributor, who is his closest, reach point, touch point. The distributor will have 2 or 3 options. One, he will place a requisition with the manufacturer for procurement of that part and then replacing. I think the answer continues to be the same. The distributor is only a funnel or a channel. The answer is there is no liability. But because of the urgency or because of the immediate service promise, the distributor may also replace it from his own stock. Mind you, this replacement of his stock is on behalf of the manufacturer. In such case as well, the circular has clarified that it is not liable to GST. Once this replacement is done, okay, then the critical point which emerges is how does a distributor recover this replenishment from the manufacturer? Here he will have 3 variants. One, he seeks that particular product from the manufacturer. Basically, it's a replenishment of goods with goods. The manufacturer sends it through a delivery challan, just like he used to send it to the customer, no tax liability. 2, the distributor, manufacturer sends it through by way of a tax invoice. Okay, and he pays the tax, and then the distributor issues a credit note and they square off this transaction. That's the other possibility. Thirdly, the manufacturer and distributor have a running account. The distributor debits the manufacturer, in which case then and a manufacturer issues a credit note in favor of the distributor, in which case the distributor will charge the GST and the manufacturer takes the input tax credit. There's also a variant where only a credit note is issued by the manufacturer because that particular product originally was under a sale invoice to the distributor. The distributor has not used it for its own purpose and applied it for the customer. So he issues a credit note, in which case it's kind of a purchase return for the distributor and a sales return for the manufacturer, in which case the distributor reverses the input tax credit. Effectively, the government does not want to tax this warranty replacement, whether it's done directly or through the warranty or through the distributor channel. So the only thing we need to take away from this is what is the documentation we place, which mechanism are we following, and we have to follow that consistently across all our distributor channels, okay, and ensure that the documentation contains the particular aspect of narration of being warranty emerging from a warranty claim with the warranty documentation backed up in terms of the claimant, etc. I think that should solve our problem and we should not have a legal issue. I would also quickly jump onto this next subtopic of extended warranties. We had a circular previously, 195, which spoke about extended warranties. Somewhere the warranty was being treated as part and parcel of the composite supply. So extended warranties which are sold at the time of the original sale I think, is a composite supply and treated as part of parcel of the sale. And no, and it was considered as liable to tax at the same rate as with which the goods were being taxed. So if you sell a phone and you sell an extended warranty, both were taxed as a bundle at 18%. But if the extended warranty was purchased, let's say 30 days afterwards, 3 years, 5 years, depending upon the terms, depending before expiry of the inbuilt warranty, then it was treated as a separate supply. Despite this, the original circular said that it is going to be taxed at the same rate at which the original supply is. Somewhere this is what the circular implicitly stated. Now they have said that let's demark the extended warranty from the original supply. If the extended warranty is after the original supply, then it will be taxed as a warranty service. Of course, there is no warranty service in the HSN schedule, but it's been taxed as a warranty service at, I presume, 18%. So I think the case of warranty somewhere has now been settled. We have the Supreme Court's decision on Mohammad Akram Khan's and Sons, which has somewhere now taken a backseat because of these circulars. Okay. And whether you replace these parts or whether you replace the entire goods, the principle of law continues to remain the same. I'll go to the fourth issue now. The fourth issue is on the fixing of monetary limits. Okay. Fine. Yeah. On the fourth issue of IGST paid due to upward revision of price. Now, the industry had this grievance that for an export with payment of tax, any price difference or variation beyond the shipping bill was not being permitted as a refund back to the exporter. The law also did not provide for a mechanism to claim this. So as professionals, as practitioners, we used to claim this under any other category, but of course face the challenges at the ground level in respect of establishing that this is with respect to a particular shipping bill. Generally, price difference happens because of escalations, because of international market prices, because of certain markups which are, or price costs which are not known at the discharge port but are known at the port of, sorry, at the loading port but are known at the port of discharge. Now, if we had to look at this, the automated and the forms which are available to us on the portal have checks and balances which map it to the shipping bill. And we were unable to file these refunds because of those checks and balances in the form. Although the law does not explicitly link an export invoice to a shipping bill to always match, because section 15 of the GST law and the customs valuation are independent, but somewhere this was an implied requirement by way of a circular. Now, yesterday, the board has issued a circular prescribing the mechanism, and this is also being translated by way of amendments in the rules to say that if you have upward revision in price, you can file a separate refund application. Now, what was interesting to me is that this refund application also has to be filed within 2 years, point one. Two, it has to be filed under any other category. But when I went through those conditions, it stated that I have to give the proof of inward remittance. So look at the scenario where I export in the month of July. I have an upward realization or a revision in my price in September, let's say, hypothetically. The primary export is eligible for refund without immediately justifying the receipt. So I could have gone and applied for the refund without having proving the FIRC as yet. I may have to prove it at a subsequent point of time. That's different, but I don't have to wait for the inward remittance to encash my amounts. And it was an automated process. I filed the shipping bill. It was directly getting it credited to my account. But when you have to apply for refund for the supplementary invoice or the debit note, which is emerging by way of an upward remission, the conditions which I could understand, which just came out last evening, is that you will have to prove the inward remittances also arrived prior to applying for this refund. Now, I think this is slightly onerous because when the RBI permits 1 year and you're filing for the refund much before that, of course, if you're filing for the refund after that, I find it justified to seek the FIRCs. But if you're filing it before that, I think you will have to necessarily prove the inward remittance prior to filing the refund for the upward revision. Now, interestingly, the law also says that if there's a downward revision, you'll have to repay back voluntarily the amount and with interest. Honestly, I don't see this emerging from any legal provision. Yes, some may argue that if there's a downward revision, then you have to give back the refund. I don't see a legal threat to this. And we'll have to see. I mean, what the circular tells us is that you have to repay it back voluntarily. Otherwise, it will be recovered as erroneous refund. Then we go on to the next issue, which I think Rahul will take on ESOPs.
Yeah, thanks, Rishabh. The next issue is regarding taxability of ESOP. So what is a common practice? What we normally see is the companies have been giving or offering this employee stock option plan as part of their compensation packages to the employees. In the context of foreign multinational companies, what generally happens is that the foreign company grants this ESOP and also allots securities to the employees of their Indian subsidiary company. And then what happens subsequently is the Indian company reimburses this cost of these stock options to the overseas counterpart. And on the ground, what was happening so far is the authorities were treating this reimbursement as import of service in the hands of Indian entity. And they were seeking GST demand under reverse charge for the Indian company. Industry had to knock the doors of High Court to seek the relief, and also simultaneously they approached the GST Council as well, or as well as GST policy wing to issue appropriate clarification to settle this issue. So now what has happened, the board has issued a clarification pursuant to the GST Council meeting. And the circular, what it does is it intelligently breaks down the entire transaction into 3 small transactions. First and second one being simpler in nature, as we can see on the screen, transaction number 1 is when the Indian company is issuing ESOP to its own employees, which transaction is very simply out of ambit of GST because it is covered under Schedule 3, which clearly says that any service given by employee to employer under an employment contract is out of ambit of GST. Where there was no ambiguity, it was clear. Transaction number 2 is when the foreign holding company is issuing the ESOP, as well as afterwards, when the ESOPs are vested, they are allotting the shares to the employees of their domestic company. On that also, the transaction was clear even in the past that because securities are neither goods nor service, and hence that should not be also leviable to GST, this transaction. Now comes the third, which is the important transaction where the entire ambiguity was lying and where the entire demand was raised by the authorities so far, where the domestic company reimburses this cost of options or shares allotted to the employees to its foreign counterpart. On that, as I mentioned, the authorities were treating as import of service and levying GST. Here, the clarification says that if this reimbursement happens on cost-to-cost basis, that is without any element of additional fees, markup, etc., then it will not be subject to GST. For the simple reason that the reimbursement is towards transfer of shares or securities, which is again neither supply of goods nor services. The important point to note here is they have carved out a different scenario, which is transaction number 3B. In the scenario where the domestic company charges an additional fee or a markup and not pays the reimbursement or not pay the amount on cost-to-cost basis. In that scenario, what happens? So what they have clarified is that when the additional fee is being paid by the Indian company, that is towards the facilitation of service being done by the foreign company. So there the element of import of service gets triggered in. And on these, only on the additional markup or the consideration, GST will have to be paid by the Indian company under reverse charge, is what is being clarified. Now, there are some key important points which emerges or which we observe from this clarification. First of all, this clarification is issued in the context of foreign multinationals. So the question comes whether can we apply it in the context of domestic companies as well, where the domestic holding company issues share to its domestic Indian subsidiary company itself. In our view, yes, there is nothing stopping us from applying the principles because the test or the underlying regulation provisions remain similar. Another issue comes in. So what has happened because of when this demand was getting created, a lot of companies just to avoid litigation has paid this amount of GST under reverse charge. Some were eligible to take credit, took the credit. Some were not able to take credit, they had paid the amount and it was a cost on them. So the question comes now, the clarification is being there, which is beneficial to assessee, and time and again, courts have held that any clarification which is beneficial to the taxpayer has a retrospective effect in nature. So this clarification, going by that logic, can the taxpayer file a refund of whatever they have already paid? So if they have taken input, they can, if and the balance is still lying in the ledger, can they reverse this credit and file for a refund? Or when they were not eligible to take credit, can they file a refund? Is something which we need to look at. Thirdly, another interesting point comes is the circular says that it should be on cost to cost basis. It also says that means equal to the market value of securities. Now the question comes, the market value of securities has to be seen on what date? Assuming it's a listed entity, then on which date? Because in the entire journey of ESOP, there are multiple events. When ESOP is granted first, then it gets vested, then the exercise happens and the allotment happens. So on what particular date one has to look at the market value of shares is something which is an open area which someone has to analyze. Another important problem comes is in the context of unlisted companies, when there is no market value available as such in the market, then one has to derive the value basis which methodology, because again there are multiple methods given under different laws, be it a net asset method, discounted cash flow method, or whether someone has to take a valuer certificate to take a sort of evidence of particular value. These are something which are some open areas which someone has to look at, and companies need to evaluate it before taking any final position on this regard. Moving on, the next topic is a very interesting topic, which is a corporate guarantee. So this topic has become very interesting and very litigative topic as well under GST. And the government has issued series of notifications, circulars to clarify this particular ambiguity, and then which led to fueling more litigation. Now they have issued more clarity. So with this, is there a guarantee that all the issues on this corporate guarantee has been resolved? Let's look at it. So corporate guarantee, as we all know that in a simple terms, it's when the one entity is giving guarantee to the lender, which is either, it could be either bank or financial institution, for a loan taken by its group entity. And the guarantees for what? Guarantees that they will honor the debt in case of a default by the borrower entity. Now, what has happened in this entire journey of corporate guarantee? Initially, a lot of litigations were arisen while we had a judgment of service tax regime that in the case of Edelweiss that there is no service tax applicable on corporate guarantee. The reason given there was that there is no consideration being charged and hence there is no service tax applicable. However, in GST, because the way the taxability got changed, Schedule 1 deems a transaction between two parties or other deems taxability even if there is no consideration for a transaction between two parties, and which led to a lot of litigation around it. And all the authorities were taking ad hoc valuation. Some were taking 0.5%, 1%, 2% valuation was being taken across the country. So the council met last year in October 23. They recommended that, okay, there has to be a synchronized valuation has to be given. And they also went one step further that, okay, I will not allow you a benefit of the proviso that this 1% valuation has to be paid regardless of whether you get the full ITC or not. Pursuant to council meeting, obviously the notification were issued. The new rule, which is Rule 28.2, was inserted in the act, in the rules rather. and which prescribed this deeming value and also overriding the proviso which was giving the relaxation of full ITC benefit. And they simultaneously clarified that in case of personal guarantee by directors, there will be no GST because the value will be nil. They cannot charge, so the value is nil. After this amendment, while the amendment was intentionally done to clarify the issues, whether what happened is reverse. The litigation got fueled up drastically. DGCI became very active. All the other authorities became very active. They issued plethora of notices on this particular topic, deeming or rather asking GST not only after 26 October 23, but also before October 23. Rather, from the inception of GST law came in, they were asking this 1%, taking 1% value and asking GST on that particular amount from all the companies, regardless of whether the recipient is able to take ITC or not. And also there were multiple issues around it, which was not clarified in the previous council meeting and the law, that what should be the timing of supply, what happens when there are multiple guarantors are being there on the table, what happens when the guarantee amount is huge umbrella amount, but the actual loan utilized is very lesser, and also what happens in the multiple scenarios. For example, if let's say there is a change, etc., what happens? So a lot of issues were there across the table. Now what happened? Council again met recently in June 23. They recommended that okay, we have to clarify all the issues. Also, the relaxation of that full ITC has to be also been given in this regard. And before that council met, rather there was a litigation also reached High Court level because on the taxability of this corporate guarantee, especially in the Punjab and Haryana High Court, in case of Acme Clean Tech Solutions, they approached High Court that this entire circular is ultra virus to the Act, and rather the court even stayed the effect and operation of the circular which was issued on the previous council meeting. And in fact, even Delhi High Court also in case of Sterlite power transmission also issued a notice to department on the validity of this Rule 28.2. Because of a series of events, as I mentioned, council met and they told, let's clarify the issues. And recently, which is day before yesterday on 10th of July, they issued a notification amending the Rule 28.2 to do three major changes. Number one, they have given this relaxation of full ITC. If the recipient is able to take full ITC, any value can be taken. And now we have two circulars in this context. One was for distinct persons. Now one is for import of service between group entities, that if you have not issued an invoice, even a nil value is accepted. So we can draw an analogy here as well, that if when there's no consideration, no invoice is issued, even nil value will be accepted if the recipient is able to take full ITC of it. Another major change they did is 1% valuation, they made it per annum. Earlier, the position taken by the companies were 1% is for the entire guarantee because there was nothing being prescribed of per annum, etc. But they have clearly added per annum in the rule itself, which is effective 26th October 23 onwards. And third major change was they've excluded the applicability of rule in case of export of services. So that was the major overhaul in this entire Rule 28.2. And what happens is, apart from that, there's a lot of clarification issued yesterday on corporate guarantee to clarify all the issues which I mentioned. That what happens if the corporate guarantee is issued before 26th October 23, whether it is taxable or not taxable. Circular clarifies that it was always meant to be taxable. We only prescribed a valuation which was absent. We gave 1% valuation from October 23 onwards, but it was always being taxable is what circular clarifies. And prior to the circular, they are saying that you take the normal valuation rules to value the guarantee. They also clarifies that the guarantee, corporate guarantee is, if it is issued on or after this date, you have to take the 1% value. If it is before, then you have to go with the normal GST, which led to interpretation that if the corporate guarantee is issued, let's say in the pre-GST regime, in the service tax era, then the point of taxation of the particular guarantee has already lapsed in the pre-GST regime. If there's no renewal happened, nothing happened post GST, then one can evaluate a position that whether they need to even pay any amount of tax or not. Another important clarification they have issued is with regard to there are multiple cases I mentioned that their corporate give a umbrella guarantee to the bank that up to this limit you can take any amount of loan from the bank. And many times what happens, the corporate doesn't even exercise any loan amount. The guarantee is there in place, but they don't end up taking any borrowing from the bank. In that case, also circular says that you have to pay 1% on the guarantee offered, because they are saying the guarantee is for the risk of default, which again is a question that is, can there be a risk of default when there is no borrowing being taken? One has to look at in detail. Another clarification they have given in case of co-guarantors. What happens is the entire four group entities sometimes guarantees for a loan taken by one borrower. There they have clarified clearly that, okay, it has to be proportionately allocated between all the guarantees. Earlier, there was a confusion that whether each guarantor has to pay 1% individually. What will happen is, if there are four guarantors, you end up paying 4% on the amount of guarantee. That they've clarified very well that it has to be apportionated amongst the guarantor. If there is no ratio prescribed, you can equally proportionate. And they also clarified that it is under forward charge mechanism unless the guarantor is outside India. Otherwise, it has to be paid by the guarantor entity under forward charge, and the recipient can take the input credit of it. So again, I mean, maybe the moment I started, that is there a guarantee that there is no issues now remains unresolved in corporate guarantee? The answer you all know better. Yeah. We'll move to the next topic, which is regarding the place of supply for B2C supply of goods. So what happens, again, it's an interesting issue, and the clarification is issued in the context of largely for e-commerce players. So what happens in e-commerce industry is that uh, you supply goods to unregistered person, and there could be different bill to address or delivery addresses in that case. So last in October 2023, an amendment was made in IGST Amendment Act. They have inserted a new section 10(1)(ca) to provide that for this B2C supply of goods, whatever address you record in the invoice, you take it, and then you determine your place of supply. Accordingly, you can charge the type of tax, be it a CGST, IGST, or IGST. But what happens when the bill to is different from ship to, right? In that case, what they've clarified is that when there are two addresses recorded on the invoice, and because the earlier section was not clarifying which address to be taken, now they've clarified that you take the delivery address which is there on the invoice as the place of supply, which is also in line with the destination-based tax principle of the law. And this circular, we believe that holds quite a good importance for e-commerce industry as well as other industries as well. And the entire players in D2C industry should review their tax positions, logics there in the ERP to determine the place of supply and make appropriate changes. Now the question comes here is that what happens, let's say I have not gone according to this particular rule, and I have paid taxes or I've determined my POS basis, let's say bill to location. This clarification says you should go as per delivery address of the recipient. I have charged GST. For example, my bill to party, let's say in same state, I have charged CGST, SGST, but I have delivered goods to another state. It should have been IGST transaction. What happens in those scenarios? Whether I need to pay extra taxes. So here, there's a specific section provisions in GST Act, section 77, which takes care of these scenarios that in case you have paid wrong nature of taxes and you either voluntarily or pursuant to a notice pay the right nature of taxes, you can file a refund of wrong type of tax and pay the right nature of tax, and there will be no interest consequence also, which is also subsequently clarified by Circular 162 in 2021. They have also clarified that you can file this refund, and the 2 years timeline to file refund also will start from the date of payment of the right amount of tax. So here the industry can either voluntary correct for the past non-compliances if happened, or they can wait for the notice, is the call they have to take. Yeah. Moving on further, these are the possible scenarios you can see on the screen which can happen for a bill to ship to supply. First one being clarified by the circular, and where it is hybrid. I mean, whether either the bill to party is registered, ship to party is not registered, or vice versa. These are something ambiguous scenarios which remains unclarified. One has to take in suitable position depending upon if they have the scenarios. Yeah. Moving on, again, post-sale discount, which is again a contentious issue from the inception of GST or rather even pre-GST regime as well. One of the condition of post-sale discount is that the supplier should ensure that the recipient or my customer should have reversed the ITC on the GST amount, which is mentioned in my credit note of the post-sale discount. However, as you all are aware that it was practically next to impossible for a supplier to ensure that my customer has reversed the ITC or not. And time and again, department has been issuing notices on this as well and seeking demand on this because no one was able to prove that. And two big players, Hindustan Unilever and Tata Motors, approached Rajasthan High Court questioning the validity and asking that government should prescribe a mechanism on this regard. Now the borders came up with a circular on this for a time gap arrangement. They have borrowed the same principles which was there in 3B2A mismatch notices that hey, if you have GST involved in the postal discount more than 5 lakh rupees, you take a CA certificate from the CA of the customer. And if the tax amount is less than 5 lakh, you take a declaration from your customer that they have reversed the ITC. And this is more of a interim arrangement till the time they built automatic functionality on the portal. While this is a welcome circular, welcome clarification, which gives some mechanism to verify this circular is giving this additional condition that you have to give a certificate to prove that you have reversed the ITC. Can a circular legally put an additional conditional obligation? Because time and again, the courts have held that a circular which is prescribing a condition or an additional obligation which is beyond the legislation are ultra virus. They are not sustainable at will. So we have to look at whether someone challenges this on this ground and whether what view the courts take on this ground is something we should look at. Yeah. Moving on, yeah, Rishabh.
Yeah. Thanks, Rahul. I think we'll quickly move on to the next topic. Now, Section 50, which spoke about interest. We all know interest is to compensate the loss of revenue to the government. I think that's a accepted position. GST has this peculiar system which was not there in the erstwhile regime, where you have something called a ledger where you park your credits and your cash amount. As in when you file the returns, the amount from this wallet, if you may call, be it a cash wallet or a credit wallet, gets adjusted with your output liability, which sits in your liability ledger. So far, so good. Now, since this is a two-stage process, it's not a one-click process, you could have a time gap between credit sitting in your ledger and adjusting it with your liability, cash sitting in your ledger and adjusting it with your liability. The first issue somewhere got taken care of by the earlier GST Council by way of an amendment, retrospective amendment in 51, which said that if you filed your returns belatedly, then to the extent of the credit payment which was available with you, you need not pay the interest. So if there was a belated filing of your return, to the extent of the credit which was used to pay that, there was no interest. Now I think that's more or less accepted. But there was ambiguity in respect of cash. So you could have loaded your cash ledger on 20th. But for some reason, the returns got filed maybe 25th, maybe 30th, any day after that. We were taking a stand that interest is not applicable and we were filing the returns. Fortunately, the interest was not auto-computed onto the return. But department said, for whatever reasons best known to them, that this money comes to the government account only after you file the return when it's adjusted. Until that date, it is easily withdrawal by you. So therefore, interest is applicable irrespective of the amount of balance which was lying in the cash ledger. See, firstly, they started off on the wrong footing that the cash ledger does not sit into the account. It certainly goes to the government treasury. There is no dispute on that. It forms part of their monthly cash collections. And that's what the government runs on, in fact. The government does not run on credits. It runs on cash collections. Secondly, that money was not easily retrievable. We all know the rigors of filing a refund. Cash ledger refund is also not easy. Now the GST Council has taken cognizance of this. And they have said that if you have balance in the cash ledger on 20th, that is the due date of filing the return, and you have belatedly filed the return, then in that case, interest is not applicable to the extent the cash balance was available on 20th. So for a 1 lakh liability, for a 2 lakh liability, if 1.5 lakh was in the cash ledger and 50 lakhs was lying as balance in the credit ledger, 1.5 was lying in the credit ledger and 50,000 was lying in the cash ledger, no interest was applicable. Now, there's one open issue still left, or I would say two open issues still left. One is, what if you had cash balance, but you belatedly reported this invoice in a subsequent return, which is very much possible. Okay. The amendment as of now does not address it. So let's give you an example. You have cash balance on 20th April. For some reason, you fail to report this. You reported in year 1, possibly, but you fail to report this in 3B. You filed that return. Okay. Next month, you realized, oh God, my 1 and 3B there is a mismatch. There is a short payment in my 3B. You recompensate that by way of enhancing your 3B. And you're using that very same cash ledger which was there in the previous month on 20th. Whether that issue gets addressed, I think time has to tell, but I don't think that seems to have got addressed. The second open issue which we are already grappling with, which is even irrespective of this amendment, is whether you delayedly report an invoice. An April invoice which is reported, returns are all filed in time. April return has been filed in time. May return has been filed in time. But that April invoice is reported in June. You still have carry forward of credit. Whether interest is applicable, technically, the law does not provide so. But mathematically, the government already has that money and therefore interest should not be applicable. So I think that's something which is still to be addressed by the council. Courts are looking at this currently as we speak. We'll have to wait for some clarity. In my personal view, no interest is applicable even in such a scenario as long as the cash balance is maintained. Going by the fundamental principle that it's compensatory for a loss of revenue. So the government has to establish that there is loss of revenue to the extent of the unpaid amount in case of interest on this aspect. We'll go on to the next slide. Now, we've had initial tough years where 2A and 2B never matched. None of the companies were able to match it. We ourselves were not able to match our own 2A, 2B. That's the state of affairs which were there in the initial periods. So we all went to the courts saying that it's impossible for us to prove that the supplier has paid the tax. It is impossible for us. Yes, you have given us a benefit of declarations and CS certificates, but many of our suppliers are too big for us and we can't furnish those certificates. Their CA is now going to furnish to us that certificate. And the industry went back to the council and said, why don't you reintroduce the 1A, 2, 2A, 3 concept, which was initially envisaged in the GST launch, but the portal was not yet ready. So why don't you bring that back? So now welcome 1A. Why I'm saying welcome is because we have one more table to reconcile now. One more additional to do for the team which is filing the returns. one more check and one more customization to our existing software to generate a 1A for filing online. Yes. So I think this 1A basically addresses the entire industry's grievance that we cannot enforce this invoice onto the supplier if he has not uploaded. There is no tool available with us. So now government said, okay, done. I'll give you this tool. You've asked for it. Whichever invoice you believe is missing on the portal, you upload it on 1A. The counterparty, which is the supplier, will have to approve, reject, modify, and then things will fail. So now I would say this 1A is not a facility, it's a responsibility on us to ensure that if there is an invoice, immediately go on to the portal and file it. How this is going to be done, at what timelines, I think we are yet to see the final. I think the rules have just come out last night. So even I'm yet to see those fine print and the timelines. But I presume it's going to be somewhere after one is filed, 2B is visible, but before your 3B. I think that's how the rule is going to be framed.
Right.
To what extent we can do this, and to which, what is the last month in which can we do this? I think September or November should be the last month, but that's something for us to watch out for. Next. Let's go on to the other issue now of monetary limits. I think this is more a litigation policy or decision by the department. You can file your appeals irrespective of the amount, even if as low as 1,000 rupees. Below that, there is a discretion by the appellate authority to admit or reject. But the department can not file an appeal against an order of the tribunal if the monetary amount is less than 20 lakhs. High Court, 1 crore. Supreme Court, 2 crore. Now, mind you, how do we calculate this? You need to take the aggregate of tax. Sometimes orders are only for interest, then you take the aggregate of interest. Sometimes orders are for penalty, take only the penalty. So depending upon the core substance or the core issue which is there, I would believe. So if the issue is only interest, then restrict ourselves to interest. This is how the department is filing, considering its policy, litigation policy. How this helps is, in some sense, there is the cost of litigation being quite high. If the department does not file an appeal, the taxpayer also saves its effort and time and cost on litigation. And secondly, it somewhere brings a win-win situation for small litigation matters, which the government may not really gather much revenue. But this decision of the department not to file an appeal cannot be considered as a continuous one year on year. That's point one. Two, as taxpayers, we cannot claim that since department didn't file an appeal for the previous year, this year that issue is settled and you cannot raise a demand. I think that cannot be, pursued. The demand can certainly be raised even if the amount is irrespective of the threshold. Three, there is some window which the circular has given to the board that if they believe that a matter is of interpretation or of national importance, etc., irrespective of the amount, they can file an appeal. But I rest, it's more an administrative order. Let's go ahead. Yes, I think this is a wonderful amendment, a welcome amendment. We all have rightly or wrongly faced with demands under RCM. Okay. And why I say rightly or wrongly? Because RCM is creditable, fully fungible. Now, once these demands are created, the next course of action or the decision which is made to us is whether we can take credit out of this. By the time the demands are raised, we would have missed the bus of 16.4. But I think the department failed to appreciate. And we were always of this position that credit can be taken the moment you make the payment, irrespective of the time limit under 16.4. But now this department was not of this view. So the board has come up and stated the day you raise the self-invoice for an unregistered RCM payment is considered as the start time or the clock for claiming the credit. So if, like this example, even if your transaction is of 21, if you have made the RCM payment today pursuant to a show cause notice under 73 or a GSTR 99C procedure, you still can take credit today or up to November following the day you raise the self-invoice. That's the sum and substance of this slide. Next. Friends, I think I'll quickly, I know we are short of time. I'll quickly take you. I think this is Rahul's slide. So Rahul, you can take it up. Sorry.
Sure, Rishabh. Yeah, so one more important update or the development from the GST Council meeting is introduction of amnesty scheme for the past litigations. So what has happened is they have proposed to insert a new section 128A, which is going to happen in the budget on 23rd of July and should be applicable afterwards. Is so this amnesty scheme, what it provides is it gives a conditional waiver of interest and penalty, which are the years involved, 3 years of the beginning, 1718, 1819, and 1920. Initial 3 years of GST implementation, if there is a demand notice being there issued under section 73, which is for bona fide uh, practices. If you have a notice pending for 73, the condition is that you have to make the payment of tax amount by 31st March 2025 to avail the benefit of the scheme, is what the amnesty scheme talks about. And they've clearly excluded the scenario of erroneous refund. So, for example, the major burning point of the industry was that in the initial years, a lot of refunds were claimed, which were subsequently found to be non-compliant with Rule 9610 because they have also opted benefit on import schemes. Those erroneous refunds are specifically excluded from the ambit of this particular amnesty scheme, which is a major hit to the industry because industry was expecting even a relief for those matters as well, which is right now in the right sort of current framework they have excluded clearly. We have also put a matrix as to year-wise which are the particular case which could be eligible for amnesty is something which can be seen. Moving on, while the amnesty scheme is there on the table, there are multiple questions being raised or rather multiple issues which we need to watch out for. For example, if one can pay the amount of under amnesty scheme through ITC, in our view, yes, there is no restriction that you have to pay through cash only. You can very well pay through ITC. Another issue comes is that some taxpayers have already paid demand of interest and penalty on these litigations. Can they really go for refund now? Because a compliant taxpayer or a taxpayer before this amnesty scheme has been now, because of the amnesty scheme, have been discriminated on this ground. And the constitution is clearly says that two people cannot be discriminated on the same sort of ground, where one is being given a waiver who is non-compliant, who is compliant uh, has to pay the entire amount. Is something we need to look at, that while the amnesty scheme does not provide a refund option, but we need to see whether the courts can provide, even if the fine print of the amnesty scheme does not calls for a refund option. Let's see whether the court intervenes in the scenario and allows refund for the honest taxpayers. Third important issue emerges, or the question which needs to look at, is that the press release of council meeting says only notices issued under 73. So those notices are pending at different forums right now. It could be either at the adjudication stage itself, or it could be at the appellate stage. Someone would have gone to High Court also for challenging the notice or the order. Whether this amnesty scheme benefit can be availed if the notice is pending at any stage is something what is our view, but we have to look at the fine print to confirm it. Another issue or very important point to note is whether one can take a partial waiver. In show cause notice, what we have seen generally is, let's say there are 5 issues being there. One is maybe of a demand of 3B2A or whatever the demand is being there. Let's say I have a weak case for some of the issues which I want to go for waiver scheme. Some of the issue I have a solid case, and that also may be more of a ingenuine demand which the officer has raised for a higher amount. If one has to go for the waiver scheme, the right now reading might give an impression that you have to pay the entire amount in the notice involved. But we'll have to see, because in the past, amnesty scheme has been giving selective issues waiver also. So the hope is that in the fine print, they will specifically cover even the selectively issue wise also one can opt for the waiver scheme and only pay the tax amount where they want to pick it up. And for the partial show cause notice or the order, they can still go for litigation. Next important issue, another comes is that what happens if the proceeding has been converted subsequently? It started with the fraud, malafide intention 74 proceedings. Subsequently, the appellate authority changed the proceedings and now it became a 73 matter. In this case, one has to take a strategic call and maybe pay the amount, because it might be the case that the authority might convert the proceedings from 74 to 73 after March 25, after the end of the particular amnesty scheme. So one has to maybe plan it out better, that if he wants to pay the amount before the end of the scheme, so that when it is converted back, he can take the benefit of at least interest and penalty on this. And another important area is if someone has a demand only of interest and penalty, whether those are automatically dropped because of the amnesty scheme or not, is something has to be looked at. While the issues are being there, but our recommendation is industry should look at the tracker of litigation. Each and every case has to be looked at in detail as to which case warrants benefit of this amnesty scheme, because by the time this amnesty scheme will be on card after budget, after the Finance Act gets implemented and notified, and the upper time limit also is March. So there's a no maximum or no stretch time available. So one has to proactively look at the tracker and evaluate whether the scheme benefit has to be taken or not. Moving on, the next topic is simpler, that they have given a relaxation of section 16(4), which essentially gives an upper time limit to claim input tax credit for any invoice. Earlier it was September return, one has to claim in the next financial year, or it could be 30th of November, which was changed subsequently. Lot of litigations were there on this section. Why? Because in the initial years of GST implementation, the portal was not working. There were multiple issues. 2B was not available. A lot of companies could not avail the ITC within the time limit. And what happened is they missed the bus and went to the litigation went to courts and multiple higher stages. In fact, in Kerala High Court, in a recent case of TradeLink, they have told clearly that this extension of September to November was more of procedural in nature. So even the September return can be filed up to 30th of November. So what we have done, we have covered or put together a table for each financial year. What was the original date to avail ITC as per the law? Then what was the Kerala High Court judgment? If we apply the ratio of the judgment, what could be the date? And now what the council has clarified, that will be the date for each financial year. Point to note is it has not been implemented yet. It should be being effective in the budget, because they might have to amend the section itself by inserting a proviso to 16(4) to give the relief for initial 4 years. One important point to note is while the benefit is given, but one cannot avail the input now. The time limit 30th November 2021 is already lapsed. The real benefit could have been if they would have given a 1 or 2 or 3 months window right now to avail all this past input, could have been a real benefit. But uh, this is what the right now is being given. Moving on to the next point. These are the other critical developments of the past GST Council meeting. Then there were circulars issued. Then there were notification issued on 10th of July. And last night, there were a lot of circulars issued. So the major ones we have put together on this table. First one being the rate of TCS has been reduced from 1% to 0.5% for e-commerce operator when they have to deduct or collect 1% TCS from the sales made by all the sellers. It's a welcome change, because a lot of amount was getting stuck in those TCS credits, which has to be eventually filed as a refund, is something which will be relaxed by this particular reduction of the TCS rate. But the important point to note here is they have implemented this from 10th of July 2024. How the practically e-commerce operator will do till 9th of July or 10th of July, they'll have to charge 1% TCS. From 11th July, they'll have to do 0.5%. And what happens, the net value of taxable supply is you have an extra credit note in subsequent 20 days, vis-a-vis 10 days. So all those transitional issues have to be looked at in detail, and the appropriate position is to be taken for that. Next change is more of a reporting. Point number 2, that for B2B reporting was always transactional level in GST. For B2C, interstate was supplying, the one supplier has to file at a transactional level. This is in the GSTR1. Now they've reduced this limit from 2.5 lakh to 1 lakh rupees. So more number of transactions have to be reported. Industry which has lot of transactions have to change their systems to extract those reports from 2.5 lakh limit to 1 lakh limit. The compliances may get increased because of that, but one has to look at, and this is something I think they have intelligently done from 1st of August 24 and not from mid of the month is something good. Point number 3 is that for the registrations, the biometric Aadhaar authentication has been made applicable on a pan-India basis for all states. So far, it was only applicable for 3 states, which are Andhra Pradesh, Gujarat, and Pondicherry. But from 10th of July 2024, they've implemented across India. It could be a practical issue for multiple large companies to, when they're applying for registration in a remote state, the key managerial person or the signatory has to go to that particular state to get biometric being enabled or verified. But this is the maybe the need of the hour to curb the fake invoicing and fake registrations. Next being that they have relaxed the filing of annual return for small taxpayers whose annual turnover below 2 crore rupees. This is something year on year exemption is being given, and they are issuing notification each year to give this relaxation. It has been issued for last financial year also now. Next one, critical is in the budget, we are the IST and IST has been becoming mandatory. They have consequently amended the rules also for the distribution of credit by an ISD. The effective date for that is yet to be implemented. Next being tribunal, they have told the 3 months time limit to file appeal before tribunal will be notified later on. Why? Because of the appointment of president recently, there was a confusion or the view that the date already started. But now the clarification that the date will be notified later on is something a good relief. And one may look at this date might also vary state level because in each state, functioning or opening of tribunal may vary month on month. So this date may be notified at a state level differently is something which may happen. Next major amendment which is on the table is section 74A. Right now, there are different time limits for fraud cases and different time limits for non-fraud cases for issuance of show cause notices. They want to align these all time limits and issue a synchronized time limit for issuance of show cause notices, and which is likely to be 42 months is something what we hear of. We'll have to see the fine print of the legislation is what they implement. And also they want to extend right now, if you want to take a benefit of reduced penalty under section 73, if you pay within 30 days, you need not to pay any penalty at all. Under section 74, if you pay within 30 days, you can pay either 15 or 25% of penalty of the amount demanded. But they are extending this 30 days to 60 days so that the taxpayer gets more time to decide whether they want to pay the penalty and close litigations, or rather they want to go for further appeal. Last but not the least is section 11A, which is also on card, is going to be implemented in the budget. Is what that they have been issuing or giving relaxation to a lot of industries for the past practices. The new section will give empowerment to the government to give relaxation to a lot of industries if whatever they've done in the past will be accepted as is. In case of a short levy or a non-levy of taxes, will not be recovered from them for the past period. Only for the prospective period, they can make changes in the law. This is also in line with the section 11C of Excise Act. In that regime, also the section was there. It's more of a replica of this section and more of an empowering provision being there because a lot of circulars issued in the past on an as-is basis they have been issuing, but there was no empowerment being there so far. Is being rightly so they have been implemented so that those circulars cannot be challenged later on. With this, we are at the end of the session. We thank you all for your patience hearing.